All right, good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Thank you for tuning in nice and early. Tonight, we're going to be talking about how to structure property insurance for financed properties. Give us just a minute here to go live on all the platforms. I see some comments already coming in. Go ahead and drop a comment there in the chat as you tune in. And you can also drop any questions you have in the chat as you tune in. Jose would be happy to answer them. But I'll go ahead and take the chat off the screen for now so we can get started. All right. Let's go ahead and get into it here. Sorry, there we go. All right, so welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our CSO, Jose Gonzalez. We are a lender that specializes in non QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through a new loan officer training topic. And tonight we're going to be talking about structuring property insurance for finance property. So, Jose, I'll go ahead and let you take it over from here.
All right. Good evening, everybody. Thank you for joining us for tonight's training. Yeah, we're going back to the basics in the last few here because we know we're getting a lot of applications and we're getting a lot of loan officers getting really busy. So we want to make sure that the I's are dotted and the T's are crossed. So today we're going over how to properly structure the property insurance for your loans, right? Whether it's a purchase or whether it's a refi. So let's get right into it. Yeah, this is critical to understand a lot of these things because the last thing you want to happen to you is have your deal get stuck because you didn't pay attention to the tips and tricks that we're telling you here, and you get hit with a last minute condition. So, what exactly is insurance, right? For those of you that don't own a property, or for those of you that don't own any type of asset that needs to be insured, right? Well, insurance, specifically property insurance, protects the property against damage, loss, and liability. Damage to the property, loss, usually a financial loss by the insured, or some type of liability claim made against the insured. The insured would be our borrower in that case. But remember, there's additional interests that come into play here, which we're going to be discussing, which are the interests of the lien holder. Property insurance ensures that the asset's value is preserved, right? If you have one of those covered losses, damage or liability. You don't want a bankrupt owner. You don't want a property that can't be rebuilt, right? That once it was damaged, you have a $300,000 lien on it. Now, be aware, lending guidelines, pretty much this one is going to be across the board, right? Lending guidelines require property insurance for financed properties. Now, in the case of a second mortgage, right, as if you have property insurance on the first mortgage, they'll ask you to provide proof of the insurance, and in some cases, ask you to add them as an additional interest. In some cases, not, but you already have insurance. Please note that the minimum dwelling coverage amount is always going to have to equal the lesser of, notice I say the lesser of, the loan amount or the replacement cost of the structure, right? You're insuring the structure. You're not insuring the structure plus the land. So you need at least dwelling amount equal to the replacement cost of the structure or the loan amount, the lesser of the two. And the replacement cost of the structure is usually going to be determined by a replacement cost estimate document that is usually available from the agents, insurance agents, stating what value they used to determine the coverage amount. Please also note that the investor or the lender needs to be added, usually, as an additional interest in the policy declarations page via the mortgagee clause and the loan number, right? You add the mortgagee clause and their loan number to protect their interests. Now, what are the types of insurance policies out there, right? You want to be sure when an underwriter hits you with a requirement or when you're looking at what is potentially going to be needed, that you're able to consult the borrower in the proper manner, right? So, hazard insurance, or usually called homeowners insurance, covers damage caused by natural disasters, fire, vandalism, and more. Now, please note that depending on the part of the country, now windstorm is going to be maybe a separate coverage, right? So from your homeowners. Now, the homeowners coverage, the one that's going to provide coverage for the structure for your standard type of losses, is going to be either a DP3. That's going to be the lowest cost full coverage policy that's usually used for investment properties only. So it's going to be either a DP3 or it's going to be an HO3, which is your standard homeowner's policy for an owner occupied 1 to 4 unit property. So remember, the DP3 is for investment properties, usually going to be a cheaper premium. The HO3 is for owner occupied non rental properties. The HO6, commonly referred to as walls in coverage, is for condominiums where the condominium association's insurance coverage covers the exterior of the building, the walls and all the structural stuff, where and the interior coverage of like kitchen cabinets, interior walls, flooring, as well as liability insurance. Like if you get a leak and it leaks down 4 floors, damages a bunch of apartments, that would be covered by liability insurance. Flood insurance covers damage caused by flooding, which is usually an exclusion from the hazard coverage and is required in FEMA designated flood zones. Keep in mind now, real important, usually the only policy that you're going to be required in some cases for the borrower to pay for it prior to underwriting accepted is a flood policy. Because in many cases, the flood policy will not be bound unless it's paid for. Any of the underwriters already know that, so they're going to ask the flood policy to be bound and paid for and proof of payment to be submitted. Windstorm coverage is going to be a mandatory coverage in certain high risk wind prone areas where the carriers require it as a separate coverage. And I'm going to give you an example of this. South Florida, that's my local market, has US Highway 1. That's a highway goes all the way from Key West all the way up to New York. Has US Highway 1, and then it also has the I-95. So if your property is either east of US 1 or east of I-95, whichever is applicable, your policy, your regular hazard policy, does not include uh, windstorm, and you have to pay for a separate windstorm policy. So usually the combination of the hazard policy that doesn't include windstorm and the windstorm policy is going to be more expensive than a regular hazard policy that does include windstorm because it's a higher risk area. Or now, earthquake insurance, you may have run into this in some states like California, is obligatory as a separate coverage, just like windstorm, in earthquake prone areas. So be aware when you are structuring your deals if any of these additional coverages are going to come into play, because it will result in additional cost to your borrower and will affect your DTI or your DSCR, whichever is applicable. So don't get caught by surprise and have the deal fall apart. Now, keep in mind that the collateral needs to be protected, right? The lender, the investor, the bank put a big lien on the property, and they want to make sure that their collateral is protected by the insurance. But they also want to make sure that their interests are protected. How is this done? Well, you heard me mention a little bit ago about the mortgagee clause and loan number. Well, specifically, the mortgagee clause identifies the lender as a party with a financial interest in the property. So this safeguards the lender's interest and allows the lender to receive compensation directly in the event of a covered loss. So the check's not going to go directly to the borrower in the borrower's name only, because you know what's going to happen there, right? Borrower's going to cash a check, spend the money, and then what's going to happen with the repairs? Oh no, right now the collateral has been prejudiced, it's lost value, and we have a serious problem. Now, mortgagee clause is usually going to be ABC Company, Atoma / ESAU, right? Atoma, as their interest may appear, / ESAU, its successors and or assigns. The Atoma part assures that the lender's interest is recognized even if the policy details change, and the its successors and or assigns part designates the servicer who bought that, has another servicing rights as an authorized agent for the policy communication. This is super important because you know how often these loans get change hands as far as servicing. This ensures that lenders' interests are upheld regardless of policy changes and streamlines the claims processing and protects the investment. Please note then how important the mortgagee clause is and the loan number, as well as getting the name and everything correct on the policy, because the loan underwriter is going to complete a pre-closing confirmation to ensure that the mortgagee clause and loan number are correct, the coverage amount is equal to the lesser of the loan amount or the replacement cost estimate, and that rental properties have rental loss coverage equal to a minimum 6 months PITI and, if applicable, association fee. So don't forget for you to check these items before you submit that evidence of insurance to underwriting for review to make sure you don't get hit with undue conditions. And what are some additional considerations for investment properties to make sure that you don't, again, get hit with any last minute conditions? Well, you just heard me talk about this one. Rental loss coverage equal to 6 months PATIA is required for all investment properties. So make sure if you do get that evidence of insurance, that rental loss coverage is on there. If you don't specifically see it on there, but they make some references to the policy, then you may need to get a copy of the policy to confirm that that coverage is included. Maybe it's like a rental property only policy and it automatically includes it, but you got to go into the actual policy jacket to review that. So you may need the policy jacket. You may need an email from the agent confirming that in writing if you can't find what you need in the policy jacket. Rental loss coverage covers against property damage, liability, and rental income loss. And most importantly, this ensures consistent rental income flow for the investor, even during repairs of uninhabitable units, which will mitigate the financial loss due to tenant related issues, also like the tenant not paying rent or having to evict the tenant. So you can see why it is such sound financial advice for the underwriting to require rental loss coverage, right? And last but not least, you see our very helpful loan officer there with the checklist for a successful closing, right? In this case, he's looking at the insurance checklist that we're going to cover here. So please make sure to that the borrower provides a paid or to be paid, or you obtain these from wherever you have to obtain it from the agent. Provide a paid or to be paid receipt for refinances as well as purchases. Definitely. But for refinances is where it confuses some people because they're saying, we're not paying for a new policy. I already have that policy. Why do I have to provide proof that it's paid? Well, because what if the policy was financed, right? Through a finance company and there is no proof of payment, Uh, so just make sure that you reach out or the borrower reaches out to the insurance agent. They can usually put together a quick pay receipt if the property has been paid, or if not, the amount due to be collected at closing for either the purchase or the refi. Please note that the insurance should not be paid for before closing unless it is an insurer requirement, like it is in many cases for flood. Make sure you always let your borrower know that they can pay for the required uh, homeowners insurance at closing. Please do ensure that the closing date is on or after the effective date of the policy. If your policy has an effective date of August 25th and you want to close on August 20th, guess what? You're not going to be able to close on August 20th until you get the effective date of the policy updated. Also, note in some cases when you're doing a refi and the policy renewal is coming up pretty soon, you may have your buyer or slash borrower, excuse me, your borrower may be required to pay for the renewal at closing, even if the renewal may not be due for 60 or 90 days. It really depends on the underwriting guidelines of the investor that's going to be buying that loan, right? Uh, because in some cases I've seen it, if the policy renews within 60 days of closing, then they collect for the full cost of the renewal, which sometimes becomes an issue if the renewal has not yet been issued. The cost of the renewal. Ensure that the borrower name and insured name match, right? In other words, the insured name on the declarations page has to match whoever is the borrower, or else you may have a coverage issue. Definitely, underwriting is not going to accept it. Now, with that being said, please note that business purpose loans usually need to have the entity name as the insured name, as the named insured. That becomes a problem with some carriers that don't directly insure an entity, but what they do is add the entity insured under a personal name and add the entity as an additional insured. Please note that the property address must match exactly. I mean, down to the southwest being SW instead of southwest. Everything needs to match, unit number, street, all of that kind of stuff. As previously covered, coverage amount needs to be the lower of the loan amount or the replacement cost estimate per the replacement cost estimate provided by the insurance agent. Do not automatically tell a borrower, "Oh yeah, you're buying it for $500,000. We need $500,000 of insurance." You can end up with a $30,000 insurance bill in some areas like South Florida. So please note, and also it doesn't have to be the loan amount either, because in some cases the loan amount could be almost the purchase price for an FHA loan. It simply needs to be the lower of the cost to replace the structure, which is determined by the RCE, or the loan amount. So if the loan amount is $150,000 and the cost to replace the structure is $300,000, you only need to insure $150,000 for purposes of the loan. Now, the borrower may want to insure the cost to replace the structure, but for purposes of the loan, you only need to document the enough coverage to cover the loan amount, since the loan amount was lower than the replacement cost of the structure. Conversely, if it costs if the loan amount is 500, but the RCE replacement cost of the structure is only 200, you only have to insure 200. Now, every now and then I catch that mistake and I correct it for the MLOs, but hey, you could be costing your borrower a lot of money if you're telling him to overinsure the property without their really needing to or wanting to. And like I already mentioned, remember that investment property policies need a minimum rental loss coverage equal to 6 months PITI, principal, interest, tax, and insurance, and if applicable, association fee and mortgage insurance as may be applicable. So remember all these tips and tricks on insurance. Remember, you can help your borrower obtain insurance quotes as well. They want to obtain their own, you obtain it for them. Also, compare notes and see who provided the best deal, because insurance is part of the DTI or the DSCR, and in some cases can make or break the deal.
All right, thank you, Jose. I don't see any specific questions here, but definitely great to know. All right. Okay, we'll go ahead and wrap it up then. Remember that we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, where we do a new loan officer training topic. So we will see you all next week on Tuesday, 7 p.m. Eastern, for the next episode of the loan officer training series with the